So, here's what happened. It was 2:47 in the morning Beijing time. Totally off peak, right? No one's watching, most of the world's asleep. But that's when the Chinese government sent a directive. Not to the public, not to markets, but straight into the inboxes of the country's largest exporter. The instruction was clear, simple, and extremely serious. No more US dollar transactions. Effective immediately, that's it. There wasn't a speech, no tweet, no press conference, no chest thumping. It wasn't even announced. Just a directive in total silence. Think about that. It was like a line of code running quietly in the background, but one that rewired part of the global financial system. By the time the sun rose over Shanghai, Wall Street hadn't even opened yet, but the effects were already cascading. Bond yields started spiking, US Treasury markets were reacting before they even understood what they were reacting to. Global markets off balance, like someone tilted the playing field and didn't say why. All from a quiet message, just 4 words. But the impact cracked the surface of the entire financial system. People usually expect conflict, threats, maybe sanctions, some kind of friction. But this move, it was clean, surgical, and it asked a very uncomfortable question. What if this is how the dollar loses its position? Not through war, but through silence, through coordination, through design. In April 2025, China's Ministry of Commerce instructed over 400 companies, state-owned giants and private multinationals alike, to stop settling new international payments in US dollars. The leaked directive, confirmed by multiple sources, wasn't a suggestion. It was mandatory. There was no negotiation. This wasn't about tweaking some ledger. This was about rewriting the way China does global business. And Bloomberg tracked the data almost immediately. There was a 12.4% drop in the volume of dollar-based trade settlements out of China in just 3 days. That's not a dip, that's a rupture. Jing's analysts didn't hold back. They said this was the clearest move yet, that China is no longer just experimenting with de-dollarization. They're institutionalizing it. And here's where it gets deeper. This isn't just about replacing one currency with another. It's not just a technical shift, it's strategic. Since mid-2023, the yuan's share in global trade finance has jumped from 4.5% to over 7.6% by March 2025, and that's not some natural uptick. That's being engineered strategically, deliberately. You can see the structure being built. China isn't just pulling out of the dollar. They're building a parallel system, and fast. The digital yuan, it's already being used in bilateral energy deals. It's not just theory, it's live and it works. No middle layer, no dollar intermediary, no swift messaging system. It's peer-to-peer settlement at a sovereign level. So, this isn't just about divestment, this is about domination, and it's triggering fallout. US bond yields moved fast. In less than 48 hours after the directive, the 10-year Treasury yield jumped 38 basis points, hitting 5.09%. That's higher than anything we've seen since before the 2008 crisis. Think about that. We're not just talking market noise, that's full-on structural stress. JP Morgan tracked over $212 billion in Treasury bonds being sold off in just 4 trading days. That's an avalanche. And most of it came from sovereign wealth funds and big institutional players in Asia. Not retail, not traders. These are the players who hold the system together. The People's Bank of China had already been unwinding US debt, cutting holdings from $859 billion to $729 billion in just 3 months. But this wasn't just more of the same. This was a new phase. Mohammed Alerian put it pretty clearly. If US treasuries are no longer seen as the ultimate safe asset, then the entire global borrowing system could shift, and that's what we're seeing. Volatility in the bond market that hasn't been this high since the March 2020 COVID collapse. But this time it's not a shock, it's intentional, it's structural. It's a message. Beijing is saying basically, if the US weaponizes the dollar, we're going to treat it as a threat. Not a tool, a liability, and that idea is spreading. The data is already showing that dollar dominance is slipping quietly but steadily. In 2000, over 70% of global central bank reserves were in dollars. By the first quarter of 2025, it's down to 57.2%. That's not a sudden fall, but it's steady erosion. And when you add a shock like this, it accelerates. And this isn't just about China. The BRICS countries and even some close US allies are exploring other options. Prasad, a former IMF guy, said we're seeing systematic decoupling. And in March 2025, the yuan passed the dollar in Chinese cross-border settlements for the first time ever. Saudi Aramco even settled a full oil shipment to India in yuan. No dollars involved. That's a signal. It says the reserve currency status doesn't vanish with some grand event. It's chipped away bit by bit. So now you look at infrastructure. SWIFT handles over $5 trillion in transactions a day across 11,000 institutions. But it's based on decades-old architecture. It's slow, clunky, and importantly, visible to US regulators. China's answer? It's called mBridge, co-developed with the UAE, Thailand, and the BIS Innovation Hub. In March, they completed a pilot using it for $23 million in trades. Real-time, fully traceable, completely outside of US surveillance, no dollars involved. HSBC's head of digital infrastructure in Asia literally said it proves that cross-border real-time settlement without the dollar is not just possible. It's basically here, it's ready. Meanwhile, the US is still in debate mode, still talking about whether or not to launch a digital dollar. China's digital yuan is already processing over $250 billion annually. So, as Beijing builds out an entirely new financial operating system, Washington is still patching the old one. And while that's happening, President Trump goes on Truth Social and posts, "Cut rates now or we risk total collapse." That post added fuel to the fire. The market instantly put pressure on the Fed, but the Fed is raise rates and you destroy housing and small business lending, cut rates and you accelerate capital flight. No good options. The dollar index fell like a rock from 104.3 to 98.7 in just 5 days. That's the sharpest drop since 2009. Capital outflows hit $76 billion in a single week. And here's the paradox. Cheapening the dollar may help short-term lending, but it's torching long-term confidence. People are hedging into gold, commodities, even the yuan. And for the first time in 40 years, the dollar dropped simultaneously against the yuan, the yen, and the ruble. So if Washington's fiscal engine is running hot and Beijing's rebuilding the grid, who's actually holding the switch right now? More countries trade more with China than with the US. That includes longtime allies South Korea, Germany, Australia, even Chile. China's export volume is up nearly 9%. The US exports are down over 3%. The numbers aren't just bigger, they're moving faster. Bilateral free trade agreements are stacking up across ASEAN, Africa, and Latin America. The US hasn't signed a major trade deal since 2020. And the effects are showing up everywhere. US GDP is now down 2 quarters in a row, technically a recession. Real wages are slipping, defaults are up, small businesses are collapsing. Boeing, which used to be the largest American exporter, lost over $14 billion in orders in just 1 quarter. At the same time, Japan, Belgium, even Saudi Arabia, they're all reducing their exposure to US treasuries. China's pullback was expected, but the allies stepping away, that's new. And Larians had something I keep thinking about. Confidence isn't lost in one big moment. It erodes slowly because of policy decisions, because of unpredictability. So maybe this isn't China taking down the dollar, maybe it's the US hollowing it out from within. And that's the core question now. Is this the start of a new financial world, or is it the US writing its own financial obituary? Because if capital starts flowing east and trade flows have already shifted and the digital infrastructure is already live, then maybe the next domino isn't a trade deal or a new coin. Maybe it's a reserve rotation, a systemic shift. One that doesn't just hit Wall Street, but shows up in prices, pensions, and paychecks for everyone. And the most disruptive part, this may not even be the final move. It might just be a facet. Thank you everyone for watching. If you like this video, please remember to like and subscribe to our channel. See you next time.